Wellington City West was New Zealand's premium government district. Kelburn, Karori, Northland, suburbs where properties commanded over $1.4 million just 3 years ago, and professionals competed for homes with harbour views and proximity to Parliament. Now, the Wellington property market is collapsing. Prices down 30%. Desperate sellers. Vanishing buyers. How did one of New Zealand's most prestigious housing markets unravel so rapidly? And what forces triggered this sudden crash? The answer begins with a wipeout on a scale that used to panic the Reserve Bank. Wellington City West average values have crashed 29.9% from the peak, from $1,442,657 down to $1,010,714. That's a loss of $432,000 per property. Lower Hutt, values are down nearly $300,000, falling from $1,032,527 to $741,841. This isn't just Wellington's worst property crash in modern history. According to Liam Dan from the New Zealand Herald, this is worse than the global financial crisis. After the GFC, the average national house price fell about 5%. What we're seeing in Wellington right now, it's 6 times that scale in the capital alone. And here's what makes this truly unprecedented. REN's chief executive Lizzie Riley just pointed out that November 2025 marked only the 6th time in 33 years that New Zealand's November sales count was below October's. That's the opposite of what's supposed to happen during the spring selling season. Sales volumes dropped, prices nudged down, and QV spokesperson Andrea Rush is calling it a steady slide with warnings that 2026 headwinds will continue. So what's driving Wellington's catastrophic crash? Why are homeowners who bought in 2021 and 2022 now facing $200,000 to $400,000 losses? And if you're exposed to Wellington's market, whether as an owner, investor, or potential buyer, what do you do now? So in this video, we're going to break down exactly what's happening in Wellington's property market and why Wellington City West is experiencing the worst decline in New Zealand. We'll dig into the human stories, people losing $300,000 in equity, couples choosing between keeping their home or having a second child, retirees draining their KiwiSaver accounts just to hold on. Then we'll look at what's different about Wellington compared to other regions and why the rental market collapse is making things even worse. This matters because Wellington's crash isn't just a local story, it's a warning about what happens when a city becomes overly dependent on one employment sector and that sector contracts. Let's get into it. Right, so let's start with the numbers from QV's latest data. Wellington house prices are now up to 30% below their peak. The QV House Price Index for the capital fell 2.4% in just the 3 months to the end of August 2025. And when you zoom out, Wellington values are tracking close to that 30% decline from the January 2022 peak. Now here's what that actually means in dollar terms across different parts of Wellington. In Wellington City West, that's Karori, Kelburn, Northland, average values have crashed 29.9%. We're talking about properties that were worth $1,442,657, now sitting at $1,010,714. That's a $432,000 wipeout per property. Lower Hutt's been hit almost as hard. Average values there have dropped nearly $300,000. Think about what that means if you're a homeowner in Lower Hutt. You've lost the equivalent of a substantial house deposit or more in equity over the past 3 years. And this isn't stabilizing. QV's August data showed Wellington declining 2.4% in the quarter. Andrea Rush said the market is experiencing a steady slide. The REN's house price index fell 0.5% in seasonally adjusted terms in July, led by weakness in Wellington. Liam Dan from the New Zealand Herald called this not a housing market meltdown, but a full-blown crash. After the global financial crisis in 2008, the average national house price fell about 5%. Economists Arthur Grimes and Sean Hyland from Motu Research found that in real inflation-adjusted terms, house prices fell 15.3% between 2007 and 2011. Wellington's 30% nominal decline over 3 years is double that GFC-era scale. Infometrics chief forecaster Gareth Kiernan pointed out that at the same stage of the last two major property cycles, 13 quarters after the peaks in December 1997 and December 2007, house prices were only 2% and 5.5% below those respective peaks. What we're seeing in Wellington isn't just unusual, it's historically catastrophic for a major New Zealand city. So let's talk about what this crash actually means for real people, because the numbers are one thing, but the human stories reveal the true devastation. Dylan and his friend bought a multi-bedroom doer-upper in Porirua for just over $700,000 in 2021. The plan was to live in it and chip away at renovations one room at a time. But Dylan told RNZ, with everything becoming more expensive, that sort of fell away from us. Now they have to get rid of it as soon as possible. The house, which is in a dismantled state, will be lucky to fetch a bit more than $400,000. That might just cover the mortgage. Dylan said, both of our Kiwi savers were drained to purchase this house, and now we are sort of back at square one with minimal Kiwi savers, and probably no money to see at the end of it. They're staring down a $300,000 loss. They bought their first home in middle age, just after prices peaked in 2022. They were well aware that we'd timed it pretty poorly, Chris said. But it was honestly the only chance they had. A year and a half into their dream home, Chris lost his high-paying job. Interest rates jumped from 3% to 7%. The property value dropped more than $200,000. Chris described it as incredibly difficult, incredibly stressful, very tiring, lots and lots of sleepless nights, very tricky mental health-wise. They decided to hold on because the equity loss was too much to swallow, but it came at the cost of their entire retirement savings. They extended the mortgage to the maximum term. Chris said, now it looks like I'm going to be paying a mortgage into my 80s. And then there's Tori and her husband in their two-bedroom townhouse in Lower Hutt. With a busy toddler and plans for another child, they need a house with a yard and potentially a third bedroom, but the drop in value means that's out of reach. Tori told RNZ they initially thought they'd take about a $50,000 hit, which was a bummer but manageable. That number kept creeping up to $80,000, then over $100,000. She said, my husband and I have said, well, we can't have a second baby. If we have to stay here, there's just no space. It's a confronting realization, she said, to find themselves in good careers with solid pay, but it's still not enough to even buy a three-bedroom house. For now, she said they're grateful for the safe, warm, dry home they have, but it's hard to let go of the life they'd planned. These aren't just statistics. These are families making impossible choices because Wellington's property market has collapsed. So why is Wellington getting absolutely destroyed while places like Queenstown are actually up 17% over 5 years? There are three main factors hitting Wellington harder than anywhere else in New Zealand. First, Wellington was massively overheated during the pandemic boom. When house values soared 40% nationally in that 18-month period through to November 2021, Wellington led the charge. The capital saw some of the steepest price increases in the country. And here's the thing, what goes up hardest tends to come down hardest. Wellington was priced at levels completely disconnected from local incomes. When the bubble burst, there was a long way to fall. Second, Wellington has a very specific economic vulnerability. The capital is heavily dependent on government employment and public sector work. When the government implements hiring freezes, restructures departments, or cuts jobs, Wellington feels it immediately. And we've seen all of those things happen. QV's Andrea Rush pointed out, you still are having the impact of job losses in the public sector. People leaving, students leaving, people going overseas. Property investment coach Steve Goody said landlords are reducing rents 7% to 10% just to fill vacancies. He had a boarding house with 11 bedrooms where a whole pile of people left before Christmas and I couldn't get new tenants. The rental vacancy situation is stark. Head of the Property Investors Federation, Peter Ambrose, said the number of vacant rentals in Wellington is the highest he's seen in a decade. The market usually hovers around 500 to 1,000 vacancies. In June 2025, it peaked at more than 1,700. In September, there were still nearly 1,400 vacant rentals. Third, migration patterns have worked against Wellington. Net migration has slowed sharply since the post-pandemic peak. More people are now leaving New Zealand than arriving. And within New Zealand, Wellington's not attracting the internal migration it used to. Young professionals who might have moved to the capital for government jobs are now looking at Auckland or overseas. Compare that to Queenstown, The Queenstown Lakes district hasn't dropped back at all. It's nearly 17% up over a 5-year period. Rush said the construction sector in Queenstown is still busy with residential developments and infrastructure projects. The neighbouring Mackenzie district is showing increases of nearly 6%, potentially people priced out of Queenstown looking for lakeside holiday homes in Twizel and Fairlea. Wellington doesn't have that economic diversity. When government spending contracts, the capital's entire economic engine sputters. So where does Wellington's market go from here? The experts aren't optimistic. Andrea Rush from QV said that in 2026, the headwinds the housing market has faced will likely continue. The higher living costs, the rising unemployment, the broader economic downturn, stretched household budgets, the sort of migration going the other way. There's fewer people coming in now than are leaving. The one potential bright spot is interest rates tracking down. Rush said, "It's going to be interesting as spring comes along to see what happens in the housing market in terms of next year. It's probably a little too soon to tell." But here's the problem. RIAN's data showed that in November 2025, sales volumes dropped 5.7% compared to November 2024. Lizzie Riley said November marked only the 6th time in 33 years that sales were below October levels. The spring bounce never happened. For Wellington specifically, the January 2026 data showed some early signs of rental recovery. TradeMe reported demand for Wellington rentals was up 16% year-on-year, while listings rose by just 1%. Students returning to the private rental market after post-COVID declines in university enrollment are driving some of that demand. But property salesperson Adam Cockburn warned renters not to overreach. "I would not be going into a property that was typically out of my financial reach, because in the next 12 months the rent's going to recover, and if it becomes out of reach, then you just have to move again." Real estate salesperson Mike Robbers said he was optimistic about 2026, with the first big round of open homes happening in late January. Normally you find quite a few people milling around. In the last few years, the last few weeks of January have generally been quite buoyant, but QV's January data showed Wellington was the only main centre where values were still falling, down 0.5% in the December quarter, even as Auckland turned around with a 0.8% increase. Wellington prices were 3.6% lower than a year ago. Here's the brutal reality. If you're a Wellington homeowner, you need to accept that your equity position has deteriorated massively. In some areas, you've lost 30% of your property's value from the peak. If you were counting on that equity for retirement, business funding, or anything else, those plans need revising. If you're thinking about selling in Wellington, understand it's a buyer's market. Ben Castle said, "If people bought 15+ years ago and are selling now, they'll be doing well. But if you bought post-COVID at the heights and are having to sell now, that is a short window and there will be a value decrease." For investors, Wellington is incredibly risky. Job losses are reducing the buyer pool. Public sector contraction is ongoing. The rental market had a massive oversupply in 2025, though early 2026 data shows some recovery. But betting on Wellington property right now means accepting significant downside risk. And for first home buyers, you've got a difficult choice. Prices have come down 30% from the peak in some areas, which makes properties more affordable than 2021. But you're buying into a market with significant economic headwinds and continued uncertainty about job security in the capital's dominant employment sector. If you found this breakdown helpful, hit that like button and subscribe to Kiwi Property Reports. We're tracking Wellington's market closely and we'll keep you updated. Drop a comment below, especially if you're in Wellington experiencing this firsthand. Here's my final thought. Wellington's crash isn't just about property values. It's about a city whose economic model was too dependent on one sector. When that sector contracts, everything else collapses with it. Understanding that is critical for anyone making property decisions in the capital. Thanks for watching. I'll see you in the next report.